All right, so Ryan, I'm having flashbacks to 208. Okay, so I don't understand this. So the topic today is going to be if your credit is not as good, you're going to get a break regarding an interest rate in comparison to someone that has great credit. So why I'm having flashbacks to 208 was, I remember in particular, there was a mortgage broker that said to me, if this person's got a pulse, I can get them a loan.
Sure.
And what happened is, and I don't want to sound cruel, but some people should not have home loans because they are not responsible enough to handle them. And what I saw happening was when they defaulted on their loans, it started dragging the whole market down. And you know, when all these foreclosures and short sales started happening, you know, the prices of the homes started dropping. So now you've got, you know, this other homeowner who's got great credit. And, you know, I was guilty of it myself. You know, I had the kids in college. I refinanced the house a few times, you know, took equity out. So I kind of, you know, brought what I owed on the house high. You know, I needed it at the time with the kids in college. But I know one of my houses, I owed more in that house than I could sell it for. And I remember going out to like 5 people that called me, you know, Debbie, can you list my house? And I'd go out there and I'd give them a price what I could sell it for. And they'd say to me, I owe more than that. I can't sell it.
Yeah.
So I'm like having flashbacks. So you have to explain this whole thing to me.
Sure.
So understand.
This is not a loosening of credit guidelines. Credit guidelines are still very tight. The changes that went into place on May 1st don't make it any easier for somebody with bad credit to get a mortgage loan. So I want to make sure that we understand that. So this change on May 1st had something to do with what Fannie Mae and Freddie Mac refer to as loan level pricing adjustments. Okay. So back in 2008, talking about the glory years there, Deb, Fannie and Freddie decided to go to what they called risk-based pricing. Before 2008, if you got an approval, you got the same rate as anyone else got. As long as you were approved, you got the exact same mortgage interest rate. And they realized that that wasn't really going to work because people with good credit would be less likely to default on a loan than people with bad credit. So they started making interest rates specific to the person taking out the mortgage loan. Okay. And they did that by putting in these LLPAs, okay? So these LLPAs have been around for 15 years, and during that time, you've got risk-based pricing as a consumer. So if you're a 780 credit score, you're gonna get a better interest rate than somebody with a 680 credit score. If you have 20% down, you probably get a better interest rate than somebody that has 3% down, okay? And that makes sense, right? I think we can all agree that that is fine. But what happened at the beginning of January, as Fannie and Freddie came out and said, we're going to change the adjustments, we're going to change the LLPAs, okay, as of May 1st, right? So New York Times, Boston Globe, anywhere you looked on the internet started talking about, you know, the end is near, right, with mortgages, because these changes are going to make it more difficult for people to buy homes, okay? So still the same credit qualifying stuff. All they did was change the adjustments to the interest rate that borrowers are paying, okay? So number one, why does May 1st not really matter to you guys or to me at this point? So Movement Mortgage implemented the loan level pricing adjustment change on February 10th, okay? So this change has already happened at Movement almost 3 months ago. So everybody thinks it just happened, you know, May 1st. No, it happened on February 10th with us. Well, why did it happen on February 10th? Well, because if somebody went under contract on a purchase on February 10th, let's assume they had about a 45-day close, right? So they're closing on their new purchase at the end of March, okay? It takes us 30 days or so from the time they close to deliver that loan to Fannie or Freddie, right? And we had to beat that May 1st deadline to deliver the loan with the old adjustments. So effectively, we had to make this change back in beginning of February to make sure all the loans that were going to Fannie or Freddie beat that May 1st deadline. So consumers, in our eyes, have been dealing with this for a number of months. It's not something that just happened the other day.
Okay, so, I'm better if I have numbers, Ryan. So let's say, for example, I'm gonna take a mortgage out for 500,000 and I have really good credit. Actually, we're very competitive in our family who has the best credit score. It's awful. We text each other every month with the credit scores. And I have a really good credit score. And then let's say this other person takes out 500,000 and let's say they have a credit score in the 600s. What does the interest rate look like now?
Let me share this graphic that I have because I think this helps put it into perspective here. Let's just see. Can you guys see my screen now?
Yeah.
Okay. So here you have the adjustment change versus the LLPAs previous to May 1st. Okay. So any of these changes in red is worse for the borrower. Any of these changes in green are better for the borrower. When you look at this, what do you immediately see? The adjustments got worse for the people in the 720s and the 740s and the 760s, right?
Yeah.
In the adjustments for the folks in the 620s and the 640s it got better effectively. And so from that perspective, they're trying to help establish home ownership in a lower income credit profile. But 640 and 660 isn't terrible credit. We're not going back to giving loans at 500 credit scores for people. That's not the case. But what they've done is they're charging higher loan level pricing adjustments on higher credit score borrowers. Okay. Now, what that led for the New York Times and everybody to say is, if you have bad credit, you actually get a better interest rate than somebody that has good credit, right? If you look at this chart, that's the first thing that you think of. But here's the real story behind it. So this is the actual outright adjustments. And if you take a look to somebody, let's say that's at 640 with 20% down, they have a 2.5% adjustment. And if you see somebody with a 760 with 20% down, their adjustment is only 0.625. So the adjustment got worse, but they're still paying a much better interest rate than those with poor credit. But the news and media outlets got it totally twisted and started telling people, hey, you may be better off missing a car payment, lowering your credit score and getting a better rate. The fact of the matter is, better credit scores still get better rates even with these adjustments.
Now, Ryan, why did they do this?
So they're trying to even the playing field a little bit. Obviously, we don't want to have this happen, nor did NAR. So the mortgage industry, NAR, they all lobbied against this change happening, okay? Because again, in a raising interest rate environment, this feels like piling on the borrower, right? It's hard enough to buy a house already, right? But these adjustments happen all the time with Fannie and Freddie. The timing of this one was pretty bad because again, the housing market was challenged already with appreciation and higher interest rates and everything. So the timing wasn't good. But over the past 15 years, this has happened a bunch. Nobody ever talks about it. Nobody really knew about LLPAs until the mainstream media started picking up on what's happening lately. So, but they're just trying to even the playing field. That's all they're trying to do. They're trying to help the lower credit score borrowers, making it a little bit better for them. And unfortunately, within this, it's making the cost on the higher credit score borrowers. It's going up a little bit here. But yeah, that's the case. So is it a money grab? I wouldn't go that far. But it's certainly something that a mortgage company or a real estate agent wouldn't have wanted to happen, because again, it does feel like piling on to the borrower.
Yeah, I don't know. I've just always had a hard time with this. I mean, I mean, I think one of the things that I've always tried to teach my kids, and also, my parents taught me is, I mean, you don't have to have all kinds of money in the world, but boy, if you have good credit, you can do anything. And it just, I don't know. I really am having a hard time understanding why.
Yeah, absolutely. It's a tough thing to swallow. I mean, Fannie and Freddie insure the majority of mortgage loans done in the United States, right? You've probably heard the saying, "He who has the gold makes the rules," right? And that's exactly what Fannie and Freddie are doing. They've got the gold, they insure most of the mortgages in the country. They can make these changes, and there's not much that we can do other than lobby and petition in hopes that they revert these changes themselves. But you're right, with great credit, you still can do anything, but it makes it a little bit more expensive. These adjustments that you're seeing here, as you can tell, a lot of them are yellow, which just means that it was a stagnant change, but you see a lot of red on this. These changes, like I said, have been around for the past 3 months. So if you came, and got a loan on February 15th, these were already applied and nobody cared and nobody was talking about them, right? Because they're behind the scenes. The borrower doesn't really know all the stuff that's going on behind the scenes to compute the interest rate. And these adjustments, by the way, are to pricing, not exactly to the rate. So when you see a jump of 2.25%, that doesn't mean their rate jumps 2.25%. The cost jumps 2.25%.
So if you, let's say you did everything equal, you had a $500,000 loan, and let's say I have a 780 credit score above, or 779, and then you have the same exact loan, and let's say we're both putting down 20%. I mean, do you have any idea of like what it was paying before and what it's costing you now?
So let's just say, for purposes of talking this through, that the base rate is 6% today, right? So
Yeah.
That's what we're looking at, is the base rate. If you're at 780 or higher with 20% down, there's an adjustment to the pricing of 0.375. What that means to us is that high credit score, high down payment borrower may go from 6% to 6.125% in order to cover the pricing difference of 0.375. Or they can retain the 6%, but they have to pay 0.375 points to retain it. Now, if we look and say, okay, that same borrower has a 740 credit score, well, now the pricing adjustment goes from 0.375 to 1 point. Now, in order to make that up, we may have to go from 6% to 6.375% to make up for that point pricing. Or that borrower then has to pay a point, 1% of the loan, to retain that original day rate of 6%. I know that's a lot of numbers there, but I hope that kind of makes sense.
Yeah, I'm thinking about what the cost is over a 30-year period.
Yeah, that's a great question. Let me pull up here. So a lot of folks aren't really thinking right now that they're going to be in their home or loan for 30 years, especially with the possibility that mortgage rates may jump. But if you take a look at a $500,000 loan, okay, and the 780 credit score gets the 6.125, and the 740 credit score gets the 6.375, on a $500,000 loan, that works out to be $81.30 a month, or $29,266.85 over the life of the loan. So there's true cost there, right?
Unbelievable. Okay.
Ryan, are
Yeah.
other industries seeing similar credit adjustments? Like car buying is one that came to mind. Are there other places where this is?
Not really, no. This would only be really applicable to residential real estate, because this is Fannie and Freddie doing this, and that's their That's their game. So not that I know of, at least.
Good question, Aaron.
Yeah, really good question. Now, could you be seeing tightening of credit for other industries? Probably, right? You just had First Republic bank failure, SVP before then. So you've got this, a little bit of a credit crunch starting maybe in those other industries, right? And so that may have an effect on them. But in terms of these adjustments, this is pretty unique to the mortgage space.
Right. Is this across the board? Like does it matter like the loan program type? Like if someone's doing a jumbo versus conventional or FHA versus or is it just like across the board for all types of loans?
That's a great question, Mackenzie. So this is specific to conventional Fannie Mae, Freddie Mac loans. So it's not going to include VA. It's not going to include FHA. It's not going to include jumbo loans.
So if you're kind of like on that edge of like conventional versus like jumbo, then like you probably would advise to maybe put like less down on a conventional and go jumbo.
It would be worth looking at. It really would be worth looking at. What I've seen when I've run that analysis is it still may make more sense to go conventional. And I think, Mackenzie, we actually have a shared client that was just the one that was talking about this when we were talking about these adjustments. But usually it still makes more sense to go conventional. The jumbo market has tightened up a lot too. And the part of that is, especially in our area, First Republic was probably one of the biggest jumbo lenders. They would give out these incredibly low interest rates to high net worth clients because they wanted their mortgage business, and then they were going to go after all their other business, right? And as we know, Chase has since taken over and purchased First Republic, and their CEO has come out and basically said that will not be the game plan going forward. So you've started to see jumbos become a little less competitive in terms of interest rates, as these banks have been pulling back from that market, like what happened with First Republic, Institution for Savings in Newburyport's kind of pulled back a little bit as well. So it's always good to look at both options, and I would suggest any consumer do that. But we're still seeing that conventional loans are probably the better deal in most cases.
So, Ryan, there's so much stuff going on with the banking world right now.
So much, yeah.
It's a little scary out there. So when a few things, okay, because my son thinks you're like the god of predicting what's going to happen in the future there. He admires you. So there's a few things. What do you see going on with the banks? What do you feel is going to happen? Are we going to see more of this? What type of loans are people going for now? And what would you kind of advise them to do?
Sure. So at least the CEO of Chase is thinking this is one of the last bank defaults. He doesn't think that there's going to be many more to come. I was reading an article yesterday that he had put out there after they had purchased First Republic. So it sounds like this may be close to the end of the banking issues, but you still have a lot of these local banks that have really low interest rates, mortgages on their books, right? So what I'm seeing is I'm seeing a lot of people now take a look at adjustable rate mortgages. Inflation and mortgage interest rates tend to follow each other. So if we think inflation is coming down, which we've been seeing, mortgage rates may likely follow. I don't think it's unheard of that by this summer, we may see mortgage interest rates back in the 5s. So that very well could happen as inflation continues to drop. So I think we're going to see better interest rates, but people don't think they're going to be in their loan for 30 years. They think there's going to be opportunity over the next 12 to 24 months to maybe refinance into a better rate and make their home a little bit more affordable for them. So the goal right now is to get a good interest rate, as good as the market allows for, to pay no points, keep your costs down, because you're likely only going to be in the loan for a few years, and you won't have recouped that upfront cost that you paid with the points within the lower interest rate on a monthly basis. So that's what we're advising our clients right now.
So I'm thinking like, I don't know, like if you're thinking about buying a home right now, wouldn't it almost be better to buy a home right now and then refinance if the rates go down instead of getting out there when the rates go down and competing against more people?
100%, right? If rates go to 5.5 this summer, all those people that have been on the sidelines because rates have been in the sixes and up into the low sevens at certain points are going to come off the sidelines, right? That's going to give them a reason to re-enter the housing market. And we already know, especially in our area, that it's competitive out there. I've got clients that are going up against 10, 20, even 30 offers in some cases. So what does that look like if rates go down into the fives? Are you going to be against 40 or 50 offers? Who knows, right? It's happened before. We've seen it before. So the goal right now is to hopefully lock in at a better purchase price, right? Then you may be able to, if rates dip and more people enter the housing market. So lock in at that purchase price and then use a refinance as a vehicle to then make that house more affordable as rates drop over time. So that is definitely a good game plan and one that we're advising our clients on. So.
No, I was listening to something the other day that I found very interesting. I lost the first stat of how many people had mortgages under 4%, but they were saying 80% of people that have mortgages are 5% and under.
Yeah, and I think 60% of them have rates that start with a 2 or 3.
Yeah. So.
Right, that's insane. It's insane, right? And that's part of the inventory crunch that's near and dear to all of our hearts, right? People are mentally tied into that interest rate, right? And they just don't want to give it up. The house doesn't fit them anymore. The upkeep on the home is too much for them. They may have outgrown it as they've added to their family, but they're holding on longer to those homes than they would otherwise because they have this psychological attachment to this interest rate that they got during the pandemic, and they don't want to give that up.
I still think it's a great time to downsize.
Totally.
Right. If I look at the maintenance alone of what it costs, I remember that my house in Andover, what it cost me to run that house. It was like, I think I added everything up and it was about $70,000. I mean, if you downsize, you go into a smaller house. I mean, so your rate should be fine. You might not even have a loan, and then you don't have all that maintenance on top of it.
I can't believe more people aren't doing that, to be honest, Deb, because you're right. A lot of those buyers are cash, right?
Right.
So it's like, who cares what mortgage rates are? I mean, I don't like to see that, right? I need mortgages to stay in business, but there's a lot of cash out there for folks that are downsizing that have tremendous equity in their property. And it's a wonderful time for them to take that step because they have more equity than they probably could have ever imagined that's been built up over the past 5 years, So it is a great opportunity. Unfortunately, I don't play a part in that process. Hopefully they find that maybe after buying in cash that there's a reason to take out a mortgage and keep some money invested or whatever the case may be. But it's a wonderful opportunity for folks that are looking to downsize and get into maintenance free or low maintenance living right now. So,
and I think too, if they're looking like at their Zestimate on Zillow or other sites and things like that, they may be mistaken because they may have a lot more equity in the house and that Zestimate is giving them information for. That's what I'm finding. I'm looking up some of the clients that I have, and I'm saying, do you feel that this estimate is correct? And some of them are way off.
You guys know, like the one thing that the Zestimate can't calculate, right? Because it's dealing with big data, is a team like yours producing 12 or 15 offers on their home and getting into a bidding war and getting them more money than they ever imagined, right? That's not built into that Zestimate. And that's probably why they're going under the false pretenses of what their house was worth. So not new news. It went into effect with us at Movement on February 10th. It is what it is. They're helping out lower credit score borrowers a little bit, but it's still best to come to me with a 780 credit score. That's going to be your best option to get the lowest interest rates. And then, as Mackenzie mentioned, look at some creative ideas by going from jumbo to conventional to a government-backed loan, just to make sure you know all your options.
Ryan, okay, so Ryan, you changed companies. Where are you now?
Well, that's part of this whole, banking change. So Mortgage Network, who have been around for 35 years, very regional lender, headquartered out of Massachusetts, went up for sale last year. The sale was closed on December 1st. So we're now with a company called Movement Mortgage, which is based out of the Carolinas, but our whole group is still here. So we're a community within Movement Mortgage. But Movement does some great stuff. They have great product. They have the foundation, Movement Foundation, owns the majority of the company. And they're giving back to communities by building charter schools and all sorts of stuff. We just did a round of 100 grants for $10,000 each to all sorts of different organizations across the country. So it's all about giving back with them, and it's a great company.
Now, how does somebody get a hold of you if they want to get a mortgage?
Yeah, thanks, Deb. So easiest way probably is to go to my website, which is leahyloans.com. That's LeahyLoans.com. You'll find my email address, my cell phone number there, but that's probably the best way.
Okay, well, Ryan, thank you so much
Thanks,
for the
Deb.
information. You always clear up the air. We really appreciate that.
I appreciate it.